With me, S. Naren, I've always maintained on air that he is one of the biggest contra investors I've made. He's been, ICICI, Prudential, AMC. They've been calling for a correction in mid and small cap stocks for a really, really long time. So if someone who's got his call right, well, that man is there on your screen, and well, his eyes are wide open now. Naren, everyone had so-called blinkers on their eyes 3-4 months ago when they were enamored with the momentum in the mid-cap stocks. But you came on one of our shows and said that, look, I will not buy mid and small cap stocks because the valuations were out like frothy. So I mean, that technically means that you're not surprised at all with today's fall?
So actually, our view has been, first I want to point out a lot of people see this as a local correction. This has nothing to do with local correction. There was a massive global bull market from December 1 onwards, in which most of the indices had crossed 1,000 points in 10-15 days, examples, Dow, Sensex, etc. So the market was extremely overbought as on January 31st. And the current correction, I would believe, is a completely global correction. People want to attribute local reasons to the correction. But if you look at what has happened to Dow in the last 10 days, it is clearly a global correction. The starting point at which this correction happened, markets were overvalued. They were extremely overvalued on the small cap side, but they were not, they were overvalued on the mid cap side and slightly overvalued on the large cap side. So we run defensive products, and many of those defensive products at the lowest level of equity allocation as on Jan 31st in the last 5 years. So that was a sign of where the valuations were. So from a market point of view, I would say that no one can predict a correction, but from a valuation point of view, a correction was overdue. Maybe we predicted it even 3 months back, but it didn't happen, but now it has happened. A broad thought process is that one should invest in debt and equity. And our belief is that credit-oriented funds and hybrid funds which are defensively participating in equity markets, these are the two things to do, because while the markets have corrected, you should remember that as of yesterday, 1 year Nifty return was, I think, 22%. So even if you had a 3.5% correction, I would say 1 year return is more than 18%. So the markets are not cheap at this point of time to justify aggressive investing. They are only cheap to the extent that you can do defensive investing in equity, which means that even today small caps are a no-no, strict no-no, and mid caps are also almost a strict no-no.
How does one figure out that the global situation will not get ugly? US 10-year paper has gone from 1.5% to 2.7%. US economy has registered a growth rate which is way above its historical averages. So if globally things get move from bad to worse, we of course would be impacted. So what is your understanding of the global setup?
See, it's difficult to say whether the markets can correct more or not, because you have to remember, particularly in US, markets have gone up from 2009 to 2018. For 10 years, markets have continuously gone up. So it's very difficult to say in the first, when you have a 1,500 point correction or a 2,000 point correction in Dow, whether that marks whether there can be more correction or not. Our approach to this whole thing, because see, we are not day traders, our approach to this whole thing has been that there should be a relentless focus on asset allocation on the part of the investor. Having seen big bull markets like 2007, and I would say in retrospect 2017, I believe that the biggest mistakes that investors make is forget asset allocation. And in economic times, we had given an interview saying it is worrying that people are only thinking of equities as an asset class, of only equities as an asset class. We believe that equity and debt should be invested today. Is it possible to predict the bottom? No. Is the market extremely cheap now that you should not worry about when the bottom is? The answer is no, because the markets are still not extremely cheap, which is why there is case for defensive investing in equity and also investing in debt, particularly credit-oriented funds at this point of time.
What is this sniffing off? Is it a routine correction in an otherwise bull market, or would you say that this is more structural in nature because easy money days are over and interest rates across the globe are set to get heightened?
I would say if equity market was to go only one way up, then why would anyone invest in debt? Why would anyone invest in a defensive equity fund which we have been marketing? No one would ever invest in those products. I think equity as an asset class, many of the people have gone around to believing that it will never give you negative corrections. I think this is a rude reality that equity can give you negative correction just because you want moderate positive returns. Equity does not need to give you moderate positive returns, which is the reason asset allocation is the only methodology which works over the next 5 to 10 years. Is the market cheap that we can actually give a thumping the table call on equity? The answer is no. That is why it still suggests defensive allocation to equity. All our equity valuation models are not saying that the market is cheap. There is a metric which we have used earlier, market cap to GDP, that is at 8-year high. So when your market cap to GDP is at 8-year high, it cannot be deemed to be, the market cannot be deemed to be cheap. So that is why there is case for defensive investing in equity. Is India is a great structural story for the next 10 years? Certainly. So if you are a genuine 10-year investor, I think market corrections are the best periods to invest in. And that's what we would recommend at this point of time. But would we recommend aggressive investing at this point of time based on valuation? The answer is no, particularly in small cap and mid cap. This has been their view, our view for quite some time, and I would say that my PMS division, which I'm not directly managing, had returned a lot of small cap money a month back because we found that it was overvalued.
Yeah, you've always been warning people against the kind of valuations and froth building up in small and mid caps. But Naren, you know, like you said, within equities, defensives is likely to do well. The fact of the matter is that within defensives, one looks at IT and pharmaceuticals. Now, IT's already moved. We've already seen TCS make the highs that it has. Infi as well is not as cheap or as ripe as a valuation as it used to be. And mid cap IT has also run up a fair bit. So, I mean, is it obvious that you turn towards purely pharmaceuticals now? And again, within pharma, it's each a different story. What do you pick up within pharmaceuticals?
See, actually, we definitely like pharmaceuticals, and we think the companies which have problems at this point of time, due to which the stocks have done badly, are possibly better than companies which have no problems at this point of time. And I would say that to add to pharmaceuticals, I would say something like power utilities, uh, particularly the regulated variety. Many of those stocks are trading at reasonably low trailing P, and 10-year returns in most of those stocks are negative. And I would say that similarly, I would say that stocks in areas like upstream oil are also reasonably attractive. If you ask me, the metrics which I have found useful in my investing career is trailing P and dividend yield and leverage. These are the three metrics which I've used. So if there is a stock with low trailing P based on last year's earnings, a stock with good dividend yield, and a stock with low leverage, that combination I found is the best to invest in any big market correction, because even if the market correction were to turn more, these are the stocks which tend to be defensive. So I don't feel comfortable with trailing PEs of 30 and 40. The problem today with small caps is there are a number of stocks with trailing PEs of 30 and 40, and neither leverage companies are good at this point of time, and high dividend yield companies are also interesting at this point of time, particularly if they are non-leveraged companies.
Naren, a large part of this rally has been fueled by a lot of local money coming in through mutual funds into the market. Now, have you, over the last few days, through the data that's come in, seen any redemption pressure for any of your key funds? Or have you largely seen more money come in despite this fall?
Purely, normally I don't speak on near term, but from whatever I have heard, there are no redemption pressures as of yesterday in any of the mutual fund industry at this point of time. Having said that, we are hoping that investors have invested in equity oriented products, knowing the risk of equity oriented products. We through all press interactions, we focused on the fact that equities have their own risks and investors have to invest for the long term, because there are periods of time when equities actually deliver negative returns. So we hope that investors stay invested. As a house, we have been recommending dynamic asset allocation funds, which are certainly much more defensive than pure equity funds. And we have not recommended small and mid cap funds. So I would say pure large cap and dynamic asset allocation and debt are the three areas we have been recommending. And all these three areas are certainly more defensive than the market at this point of time.
Right. Normally I wouldn't even have asked you that question, but it's just that the market timing and the sell-off is so significant that I wanted to get a sense of how liquidity flows are panning out in domestic turf. The other thing is about balanced funds. Do you think that in a market like this, which may get a bit choppy going ahead, and you spoke about that as well, across the board asset allocation, that those would be perhaps most prudent, especially when the uncertainty is rising?
See, as a house, what we've been doing is, if I look at our December 31st portfolio, which is what is there on the public, equity income is about 22-23% net invested, balanced advantage is about 32%, and balanced is about 65%. As we all know, equity carries higher risk than debt. So depending on where your risk environment is, you have to choose the product. And obviously balanced fund, because they can't invest 100% of their money in equity, is safer than that of an equity fund. But is balanced advantage fund a lower risk fund than balanced fund? Certainly. So that's how we look at it, and that's what we've been trying to communicate to the investors. As we all know, equity market carries reasonable short-term risks, which we're seeing over the last 1 month globally across all markets, across all capitalizations.